The unknown loophole that let banks print risk out of thin air. 1. The lending constraint problem. A recurring structural dilemma in modern credit markets arises when institutional capital seeks higher returns but is constrained by strict investment grade requirements. A pension fund, for example, may desire to lend to a corporation offering superior interest terms, yet its governing charter strictly limits investment to instruments rated A or above. So, what does that actually mean? It means capital is available and borrowers exist, but regulatory and internal policy restrictions prevent a direct transaction. This creates a fundamental tension between the pursuit of yield and the duty to protect beneficiaries from excessive risk. Footnote: this section explains the regulatory limitations preventing institutional investors from lending directly to lower-rated corporations. 2. The role and influence of rating agencies. The credit rating assigned to a corporation determines whether institutional investors are even permitted to engage with its debt. These ratings, however, are issued not by government regulators, but by private agencies compensated by the very entities they rate. This embedded incentive misalignment complicates the reliability of ratings and creates a structural vulnerability. When a corporation is assigned a BB rating, it becomes automatically ineligible for investment by institutions bound to A-level obligations, regardless of its business prospects. Footnote: this section highlights the private nature and incentive conflicts inherent in credit rating agencies. 3. The economic appeal of lending to lower-rated borrowers. Lower-rated corporations frequently offer higher interest payments to attract lenders. A pension fund seeking additional yield may prefer these opportunities, receiving perhaps 10% annual interest rather than the significantly lower yield associated with government debt. Yet this preference is obstructed by the fund's binding investment restrictions. This creates an economic mismatch. High-yield opportunities exist, but the entities most capable of funding them are prohibited from participating. Footnote: this section explains why institutional capital desires higher-yield corporate debt despite rating constraints. 4. Credit default swaps as a structural workaround. The modern financial system created a mechanism to solve this mismatch: the credit default swap. An insurance entity, often highly rated, guarantees repayment of a lower-rated corporation's debt in exchange for a recurring insurance premium. Through this structure, the pension fund receives high-yield payments from the corporation but transfers a portion of that yield to the insurer. The insurer's guarantee effectively elevates the risk profile of the debt to the insurer's rating level, transforming a BB-rated instrument into one functionally equivalent to an A-rated one. Footnote: this section outlines how credit default swaps elevate the effective credit rating of risky corporate debt. 5. The reclassification of risk through insurance. Once insured by a highly rated institution, the previously restricted bond becomes permissible for purchase by the pension fund. The insurer does not provide collateral or reserve capital. Rather, the system relies entirely on the insurer's creditworthiness as determined by rating agencies. This allows capital to flow freely, but simultaneously introduces a new systemic dependency. The insurer's solvency becomes the backbone of the entire structure. Footnote: this section describes how insurance transforms ineligible debt into investment-grade instruments. 6. Exposure expansion without collateral requirements. The insurer can write enormous quantities of credit default swaps without setting aside matching reserves. As long as rating agencies maintain the insurer's high credit rating, the insurer can guarantee billions, sometimes trillions, of dollars worth of debt obligations with minimal internal safeguards. So what does that actually mean? It means the insurer accumulates obligations far exceeding its actual capital, creating a single point of systemic failure. Footnote: this section highlights the uncollateralized nature of credit default swap exposure and its systemic implications. 7. The House of Cards effect and systemic risk. Because multiple pension funds and institutional investors rely on the same insurer, the failure of that insurer would trigger simultaneous defaults across the system. When the insurer guarantees debt far beyond its capital capacity, the entire financial structure becomes vulnerable. If even a portion of the insured corporations default, the insurer cannot meet its obligations. This transforms what appeared to be low-risk, high-yield investments into catastrophic institutional losses. Footnote: this section explains how concentrated insurance exposure creates systemic fragility across global credit markets. 8. Incentive misalignment and the illusion of safety. The pension fund acquires the appearance of safety because the debt instruments it holds are labeled AA or AAA after insurance. But the true risk has not disappeared. It has merely been transferred to an insurer with insufficient capital reserves and maintained by rating agencies whose incentives may be compromised. This creates a legal and financial illusion. Compliance is met on paper, but system-wide risk remains concealed. Footnote: this section describes how institutional compliance masks underlying systemic instability. 9. The final systemic vulnerability. When insurers guarantee vast quantities of risky debt without collateral, and rating agencies maintain inflated assessments, the financial system becomes dependent on a fragile and unregulated foundation. A single wave of corporate defaults can collapse the insurer, which then collapses every institution relying on its guarantees. This is the essence of the credit default swap crisis: widespread exposure, no reserves, misaligned incentives, and a catastrophic cascade triggered by a single point of failure. Footnote: this section summarizes the mechanism through which credit default swaps amplify systemic financial risk.